Buradan herkese merhaba. Bu bölümde piyasalara özel bir parantez açıyoruz. Değerli bir yayın konuğumuz var. Costa ile buluşuyoruz. Kendisi Citi'nin Gelişmekte olan Ülkeler Stratejisi Küresel Başkanı. Hi Louis, welcome to our show.
Hi, very good to see you. Thanks for having me again.
Louis, let's begin again with the global picture. We are now looking at an extraordinary mix of economic warfare, trade warfare, and actual military conflict with the, latest focus on tougher sanctions against Iran. How would you assess the year so far, and where do you see the greatest risk right now?
Oh, the greatest risk is still of escalation, I would say. I like the way you kind of, dissecting it, right? So you've got military escalation now, political escalation via sanction, right? I mean, trade escalation, which is we are seeing a reflare here of Trump tariffs. I mean, versus a few jurisdictions. The last one was Canada. But I do believe that the major risk is still military escalation in the Middle East. Um, markets are becoming more comfortable with a slower drawdown of oil reserves, which is quite good, right? It averts the possibility of a big spike in oil. When I say big spike, I'm talking about 130, 140, 150, right? Something that, some oil analysts, back in the days believed that could happen by now. So, I mean, we are assessing, and our commodity team put out a very nice research piece showing that, at this pace, it will be like almost a year to get
Yeah.
to the inventory levels that we had back in the 70s, right? So this is good. This is good. So there's a little bit more time. And there's always a positive aspect here of the political, let's call it political escalation of the sanctions against Iran. It means that the White House is indeed preparing to give it a little bit more time in order to push Iran into negotiations rather than going straight to military escalation. So
Yeah.
markets are trying to cope, which is good. And carry continues to be pretty much, at the priority shelf, right? I mean, when it comes to, global investors here, especially EM global investors.
Mhm. The rise in long-term government bond yields has become one of the dominant market stories. Is there an alarming point in global bond markets? And do you think this can spill over to equities, credit markets, and broader economies? And another additional question maybe, is there a realistic possibility that Fed, ECB, Bank of Japan will have to raise rates? And what would it mean for emerging markets?
Well, I mean, the BOJ is already in a hawkish stance, right? So, I mean, ECB might deliver another hike. So, I mean, some of that is already happening, but I think it's very simplistic to believe that, a potential Fed hike, which we don't believe the Fed will hike this year, but a potential Fed hike will stop the back end from, steepening. Right. So I think that's we've got all the components here of this bearish trend in the back end, which is fiscal, which is, it has to do with inflation premium, some inflation discovery. We don't believe we are going back. The last time we had, I mean, your question is very good because you're asking about the equity reaction to the back end fixed income sell off, and we believe we're still far away from that, right? I mean, the last time international risk really suffered from a concerted sell off in bonds and equities was back in 2023. We all remember how bad conditions were, right? There was a lot of inflation price discovery coming out of COVID. So we don't have the same situation now. I mean, in some respects, for some central banks out there in the MDM, we are very close to the targets, right? So I don't think it's the same environment. But of course, we have to watch out for that because, the environment is very tricky when it comes to the back end. What we had from the US Treasury so far, I don't think this is enough. We're having, so many discussions, right, with investors and, and in the media. And I don't think that doubling the repurchase of treasuries in the back end is enough to stoke the pressure, right? So more might be needed. And most importantly, you need hints or guidelines from the fiscal side. The component is fiscal.
Yeah. So what about emerging markets and Turkey especially? We know that Turkish Central Bank has resumed its one-week repo auctions at 37 for the first time since 1st of March, and the weighted average cost of funding has decreased immediately. First of all, did this decision come earlier than you expected, or was it broadly consistent with your expectations?
I think it was consistent. Yeah, absolutely. I mean, from, the last MPC, we were already expecting, some degree. And as a matter of fact, there was a hint already in the last MPC that they could be doing that, right? So, I mean, and some follow through in the inflation report presentation. So, I mean, I think it's happening pretty much in the right time. There are risks attached to it, of course. I mean, it goes back to what we've discussed before in terms of global outlook. The risk is still on, the energy side. Are we done with the energy pressure? Are we going to improve from here? But generally speaking, these are central banks reacting to global flows into carry. They have seen a new rise, right? I mean, we had a very nice publication we share with clients every week, which pretty much shows that, I mean, the carry currencies continue to see, attempts of inflows. And so this is the Turkish central bank reacting to it. And then I think it makes a lot of sense. Will that shake off the allure of the Turkish lira in comparison to other carry trades? I don't think it's the case, right? I really don't think. I think that, it will probably be moderate, but in an environment where we are still considering the guidance of a weaker dollar, right? This is very important, right? If the dollar gets bid, I think that the story changes totally, but the guidance of a weaker dollar in the coming months, I think it's still, it's still good. So we remain positioned there. We continue to like the lira.
Okay, when you're talking, I have lots of questions in my mind. First of all, is this a technical normalization or is it the first step of monetary easing in Turkey? Because we know that in September, October, and December, we have meetings. And how much room is there for rate cuts before the end of the year in Turkey?
No, I see that as a technical normalization. I like the way you put it. I mean, central banks, they move into emergency mode, right? And then if everything, kind of normalizes and things, the volatility drops, you move back to a neutral stance. I think this is the central bank of Turkey moving to a neutralish stance and potential for cuts. I mean, I do believe that they might materialize a little bit more as we go into year end. I don't think so. Even if you hear, right, from authorities now, it doesn't seem like there's a lot of impetus here to start cutting right away, right? So, but I think and Turkey is very interesting, right? Because it's one of those energy sensitive jurisdictions together with Egypt, together with other parts of EM here, right? I mean, and I think that there is still this reluctance to establish any dovishness at the moment, which I think it's the right approach.
So in the remaining three meetings, you don't expect any rate cuts?
I think towards the end of the year, yes, I think that the probability rises. I mean, but not for now.
About the durability of this carry trade, lira carry trade, you have said a few words, but can it remain attractive if domestic interest rates decline while global bond yields remain elevated? And also, there are reports that Turkey's finance ministry is considering a 10% withholding tax on investments in money market funds. This is not something announced, but there are reports in the media. That's why I'm asking. How do you think this might affect the perspective of international investors?
Like I said, I think it's all part of a normalization, all part of bringing back the stance in an environment where the dollar is weak and environment international flows continue, right? I mean, it's very difficult now. If you look from the perspective of emerging markets, a global emerging markets portfolio manager, right? On the local side, you've got rates, and you've got effects, right? What we gather here from our models, our, monitors of flows, it shows that now we have essentially kind of, 4-to-1, right? 4 units of risk are now biased towards EM effects if compared to EM rates for various reasons. It's not only the fact that the core rates have been trading more on the bearish rate. There's some steepening there. This is not good for rates, but also the fact that a lot of the easing cycles out there, they are pretty much, down to the end. right? I mean, something that we discussed in our previous chats we had. So that makes the rates trade a lot more difficult now, right? So, and not needless to say, I mean, the geopolitical aspect in the Middle East is another, potential catalyst here against the rates trade. But on the FX side, we are still seeing, we are not very necessarily, supporters of this dollar debasement theory. But I do think that, you remember some chats we had in the past. I mean, it's been a well-behaved dollar, allowing carry currencies, allowing high interest, real interest rate currencies to perform well. So, and that's exactly where global risk is now.
Let's put it in another way. Turkey is trying to attract more stable long-term capital. Do you think if any taxation comes, this might encourage investors to extend the maturity of their positions and change their portfolio?
Well, I think this is the transition is still to be determined. I mean, I'm not entirely sure this is going to be one to one, right? Money, leaving money markets. It would depend a lot on what authorities will do in terms of incentives, basically to accommodate some of these outflows from money market funds into the short end of the bond curve, right? So, I mean, probably something might be done with that respect. There's a potential for that, but that's still supposed to be determined.
Louis, I have two last questions. One is, what is the position of Turkey in the emerging markets universe? And the second is, what is required for foreign investors to move beyond short-term carry positions and begin committing more durable capital to Turkish equities, bonds, and direct investments?
I think that's, the response is a generic response to every market that you need, better predictability on the inflation side. You need a better depth on the bond curve, right? I mean, we know that in some jurisdictions out there, Turkey is not only an isolated case. I mean, over the past years, we have seen a significant reduction of participation of foreign investors in the bond curves. It happened because of several reasons, not only endogenous shocks, but also exogenous shocks, right? So investors are looking for curves where there's decent foreign and local sponsorship, right? And those sponsorships, those levels of sponsorships will obviously improve as the inflation outlook becomes more predictable, right? So, I do believe that some central banks are doing a good job there despite all the challenges. I mean, the Central Bank of Turkey is definitely, among them. The Central Bank of South Africa, Brazil has been extremely cautious, right, in cutting in smalls. When at the beginning of the year, we were expecting over 300 basis points out of Brazil. We are not getting that. We are far away from that, right? So I think the cautious is still the buzzword among central banks. And I do believe that the Central Bank of Turkey is in the right direction in that sense.
And what is the rank of Turkey in the emerging markets universe? Who are the rivals?
Well, I wouldn't say rivals. I think that's on the carry side is still one of the leading opportunities, right? So it has a massive potential, right? Given the geographical position, given the links in terms of capital you mentioned, right? I mean, long-term capital versus short-term capital.
Mhm.
So that for Turkey has been. You will probably continue to be a very positive catalyst here in terms of amalgamating Middle East inflows, European inflows, North American inflows. So I think that's there's definitely scope and potential to replace that as down the road they lower the carry
Yeah.
advantage.
Louis Costa, thanks for joining our program.
Good to see you. Thank you.